What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about Intuit, ticker symbol INTU, and I'm definitely not saying it right, but as always, if you enjoyed this video, find it helpful, make sure that you drop a like and of course subscribe to the channel. If you're just joining us for the first time, there is going to be a 16% annual discount available till the end of this month, and you get access to all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included, as well as the intrinsic value spreadsheets and the members only private videos as well. So links are going to be down below. Only 10 more days left till you can take advantage of that discount. So Intuit, as we already know, is a ecosystem of a lot of software applications, right? And the new PayPal CEO, Alex Chriss, is a small business and self-employed vice president and developer in that area at Intuit. And of course, he's coming and bringing his expertise from this company over to PayPal as well. PayPal and Intuit kind of are in a very similar niche, not really niche per se, but they are in a very similar situation where they do run a software as a service. But of course, this company focuses very much on personal finance and accounting software, as opposed to PayPal, which is very much focused on payment processing. So as we know, Intuit's ecosystem includes TurboTax, which I have used, QuickBooks also, we got Mint, we got Credit Karma, and we got MailChimp. MailChimp is something that they recently acquired under Alex Chriss as well. He basically was the lead in acquiring MailChimp. Now, TurboTax, as we know, takes the complexity out of the tax code and helps people get the maximum refund they deserve and helps them file taxes as well. QuickBooks helps small businesses manage their books, get paid fast, manage capital, and pay employees with confidence. Mint is a personal finance app, so helps people get a holistic view of their financial picture and makes them smart money decisions. Credit Karma helps people find the right financial products, putting more money in their pockets and providing financial expertise and insights, of course, keeping track of your credit as well. And MailChimp provides all-in-one marketing platform that employees and of course customers can use to start and grow their businesses by helping customers get their business online, market their business, and also manage customer relations. So this is the entire ecosystem, which is very, very strong, very powerful. Every single platform kind of, it works together well. It's intertwined with each other. So there's no doubt in my mind that Intuit is one of the best software companies out there with excellent margins and very, very nice, consistently growing revenues. And they've gone from like 3.9 billion to over $12.7 billion, and gross profits gone from 3.4 billion to over 10.4 billion, and operating income's gone from 1.2 billion to over 2.6 billion dollars. So nonetheless, needless to say, it has grown really, really well consistently every single year. This right here, net income's gone from 858 million to over $2 billion. That's over a 15x growth. And of course, that has also increased their diluted earnings per share. It's gone from 283 to over $7, almost $8. And shares outstanding have gone down. So what we have over here is a software as a service business with a very strong product portfolio and ecosystem of companies that are not that easily replaceable. And at the same time, we do also have consistently share buyback, revenue, margins, earnings, profitability, everything moving in the right direction, with EBITDA also going from 1.4 billion to over $3.2 billion. Excellent margins. It is a software company, so you'd expect nothing less. We've got an almost 80% gross profit margin, with net margins sitting at just under 16%. With a free cash flow margin of 27%, and we got return on common equity at just under 13%, capital at just under 8%, and return on assets a little bit over 7.7% as well, with again very, very strong cash per share and net income per employee number, which has actually gone down. So what you will notice, and this is actually something that we should be talking about more as a way of efficiency from the company as well. So what we have seen for this company is net income has increased, right? So what you'll notice, it's gone up from $858 million to over $2 billion, right? That is a very nice consistent growth in net income. Now, net income per employee, which is just a good metric of understanding that, okay, what is the profit per employee? That's about 129,000. This number has actually gone down. So what that tells us is that the company is slightly less efficient than it was compared to its 5-year average, right? Because let me give you a simple example. Let's just say the net income is 800, right? Divided by, let's say there's 50 employees working there. So that's $16 per employee. But if the actual net income has gone up to, let's say, 2,000, and you do the same math divided by 50, net income per employee should increase, right, to 40. But instead, in this case for Intuit, it went down, right? So it would only go down if they hired a lot of people. So let's say 150 and now $13 per employee. So net income per employee went down. So what does that mean? That simply means that as profit grew, the company's headcount also grew, but compared to its 5-year average, we are seeing a lower net income per employee, hence making them slightly less efficient compared to their 5-year average, which was at $157,000, right? Very, very good metric. Not a lot of people talk about this, and in fact, we haven't either, but it's part of our MoneyVest KPIs as well. And we will start talking about it more and more, but slightly lower compared to what we have seen from the company before. Now, when it comes to the balance sheet, so Intuit reporting total cash of $4.2 billion with total debt sitting at just over $7.2 billion. So definitely, more debt than cash on the balance sheet. So that's not the best thing. And of course, we do have a current ratio and a quick ratio of a little bit over 1. So that's good. Debt to free cash flow under 3, and that's exactly what we look for from companies. So that's good. But of course, net debt is not there for Intuit. Now, in terms of the upcoming earnings, they are going to be reporting on August 24th. That's going to be after the markets close on an EPS normalized basis of $1.44. GAAP is expected to be a net loss of about 28 cents per share on $2.6 billion worth of revenues, and earnings are expected to grow from $14.24 this year to over $27 by 2027. That's actually a pretty phenomenal growth rate for the company. If we plug those numbers in, we're looking at a growth rate of just under 25%. For Intuit. Actually, it's going to be a little bit lower because it's 2027. It's actually going to be just under 20%. So 18% growth rate is going to be that number, but I still consider this to be a growth stock because 18% is no joke. If the company can grow their earnings by 18%, that's actually pretty solid. Shares outstanding have gone down by about 74, 75 basis points. So if we plug in some of these numbers, I'm going to go with about a 16% growth rate for this company. 20 times PE multiple, because right now I believe the valuation's a little bit higher. So if you come over to Intuit and their current valuation and where they're actually trading at the moment, we are looking at a price to earnings and a price to sales multiple, which is incredibly high at over 61.5. And of course, price to cash flow at just under 30, and price to sales trading at over 9.7. So those are, again, pretty high numbers. Price to book 7.7, enterprise value to EBITDA 35 for the company as well. So it has seen a pretty significant drop from $713 during that bear market. It was down 52%. Year to date, the stock is trailing right now, only up 22%. Hold on one second. There we go. And of course, from its lows of October, it is up about 38, 39%. So again, nothing compared to some of the other stocks out there. But let's just do 16% growth rate, 20 times PE multiple. We're going to go with 12% discount rate because the company doesn't pay a dividend. It does. Very, very small amount. We're going to not take that into account. 10% margin of safety. So after applying these conservative numbers, we get down to a fair value of $317. And right now, of course, it's trading at $485. So low 300s would be ideal. So including that flexibility range, we'd be looking at low 300s for Intuit as a very strong area of support as our fair value on this company, which is going to be in line with this previous resistance before the pandemic for Intuit as well. So that would be a level where I would consider maybe looking into Intuit in a little bit more detail, and of course doing an in-depth analysis. The net debt is a little bit concerning because they do have more debt than cash. And of course, valuation is a little bit of a problem, and of course, efficiency long-term for the company as well. But nonetheless, resistance is going to stay put at 485. So this right here is going to be that support. In fact, this is actually going to be a support right now because it was a previous resistance, and right now we're trading above that level. And of course, if we do end up breaking down, considering the RSI and the MACD very, very overbought at the moment, I wouldn't be surprised if we do see a little bit of a sell-off below those moving averages, and of course, maybe come down to 349, 350s for Intuit moving forward. So that's going to be the entire analysis. Let me know your thoughts down in the comment section below. What do you think about Intuit? Are you buying, selling, or holding? I would love to know from you guys as well. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. Happy investing, and I'll see you all in the next video.